Good afternoon, everybody. Once again, my name is Philip Resch, and we're here today to talk about an opportunity for a sales idea, or just a true understanding of how we can serve our customers. And I created Valor Financial Specialists basically as an opportunity to serve agents who are looking to help their clients, find the right solution without without having to worry about only selling one carrier. So here at Valor, we have about 30 carriers at our fingertips, both whole life and IUL, term, the whole nine yards. So really, it's about objectivity. And so today, what we're going to talk about is the differences between infinite banking, the concept or sales idea that's used, versus tax-free retirement. And so the agenda is going to go as followed. We'll talk first about infinite banking and really the product that is utilized for that, which is whole life insurance. And to know whole life, to understand it, is to understand the process of how infinite banking works. Then after that, we'll look at tax-free retirement strategies, how those are positioned and typically done with an IUL type of solution. And then last but not least, we'll do a little bit of a compare and contrast between the two. And hopefully you'll walk away with some action steps, some opportunities with clients. I would love to talk to you after this if you can think of some people who might fit. So first off, let's talk about infinite banking. When we look at whole life in general, why would someone really want to consider purchasing a whole life contract? It is tried and true. It's the old product, originators, if you will, along with term. And the whole idea of it is that you get coverage for your entire life. Okay, it's guaranteed level payments for your entire life. And on top of that, you actually get a guaranteed return on the cash value. So you have cash growth that's guaranteed, you have a death benefit that's fully guaranteed, and you have level premium payments that aren't going to fluctuate based on market performance. So that is really what you're buying when it comes to a thing like whole life insurance. It's all about the guarantees. And if you think about the formula unto itself, the main piece or the main equation for whole life is that you have, again, those level premiums. So in this example, in the top right-hand corner, you'll see that this client who's 35 preferred plus would pay $6,525 for a $500,000 death benefit. Now that premium is always going to be the same. It'll go incrementally, it will stay the same the entire time. Face amount will also be guaranteed. But if you look at the last bullet point here where it says endowment, the idea of endowment is a key piece to the whole equation of whole life. So normally in the past, endowment would be the age of 100. Recently, it's more age 121, but some contracts still endow at 100. And what that means is that your policy, if you pay the 65.25 in this example for the entire lifespan of the policy, you are guaranteed to have your face amount in cash value by the time we get to age 100 in this example, or it could be age 120. So the whole idea here is that you have guaranteed growth. Now, what you'll typically hear from a salesperson is that it's going to be a guaranteed 4%. And we'll talk about that in just a second. When we look here at the lifespan of a whole life policy and how it works, you'll find that you have the start of the policy year, client will pay their premium, and then out will come the charges like a normal insurance contract. Then after that, as the policy is continuing, you're going to get your guaranteed mortality charges also removed from that, continue to remove throughout the year. But then the company will also credit a guaranteed interest. Now here's where it gets a little sticky. So once again, I want to peel back the onion and how it's actually designed versus how it's illustrated. And so how it's illustrated and how people talk about it is they say, "Oh, you're going to get a floor of 4%. It's guaranteed. It's in the contract. You're going to get a floor of 4%." But what they don't really understand is that you're not really getting an actual 4% return every single year. The way whole life is designed, you can think of it like a 1,000-piece puzzle, or an old clock that has a bunch of gears, or cogs in the wheel, so to speak. And when you think of that 4% piece, that equation of giving you guaranteed interest, it's one tiny piece to the entire equation of whole life. Whole life, you're not buying dollars of insurance, you're actually buying units of insurance. And so it's actually a different calculation than what you would find as we talk about IULs in a little bit. And so, yes, the verbiage of 4% is in there, but you're not truly getting an actual 4%. Now, if you look at an illustration of whole life, which if we have time later, we can pull up an illustration because I can run it too. You'll find that the guaranteed column, if you run a basic design, shows 0 in that guaranteed interest column in the first couple years. So how can you get a guaranteed return of 4% if it's showing zeros in the first few years? So that's unfortunately how people are selling it, saying that you have a floor of 4%. And then ultimately, as you see the trail continue to move on, at the end of the policy year, there's a declaration of dividends. So the dividends come through. Congratulations, the insurance company stayed solvent. So they're going to give everybody a dividend. Now, the dividend, if you once again talk to a person who's trying to sell the whole life policy, they're going to say, oh, well, you have a 4% floor and the dividend is usually around 6 to 8%. So you're going to get a 10% or double digit growth every single year, which is once again a lie, because that's just how people are positioning it. It's not exactly how the actuarial calculations are dictated. And so I don't want anybody to fall into a trap. Whole life is a great product. Once again, we do sell it here, but I don't want people to get misconstrued with the idea that you're getting double-digit returns every single year. And so the dividend gets put back into the policy at the policy anniversary. It goes into the client's policy in several different ways. And this is kind of how it looks. What I want you to first understand, though, is a dividend is actually what you would consider a partial refund of the client's money. Okay, so you pay a premium to the insurance carrier stays solvent, and because it's usually with mutual companies where you all share the benefit, think of like a condo association, the benefits will then be given back to the members, so to speak, or a partial refund of what you gave to them. And so in that, you get a dividend. Now, the dividend, it gets paid out in several different ways. You can get cash back, so you can get your partial refund back. You could get a reduced premium on your policy. So if in this scenario where the client's paying 65.25, then you get a dividend of $500. You only have to pay $6,025. Or the most popular one is paid up additions. And so what you see from this screen is the paid up additions, where the dividend basically adds this extra layer over the $500,000 policy, and it grows over time. What you're buying is, in this scenario, you're buying little bits of paid up policies. So they're tiny little policies that start stacking on each other. They get cash accumulation and growth inside of those dividends, and they continue to grow the policy. So what you're doing is the insurance company is giving you your money back in the form of a dividend, and you're saying to them, I don't want this. I want you to keep it inside the policy. And then it starts stacking on top of the base policy. So I often like to equate it as icing on top of the cake, and the cake keeps getting bigger and bigger. So that's an easy way to analyze a participating whole life contract. But once again, just kind of hearing the wording and the phraseology is a partial refund of your own money coming back. So that tells me that I'm technically overpaying on my policy. Neither good nor bad. It's the value of what the client sees. So if they like the guarantees, great. If not, it is what it is. So now that we kind of understand the whole life product, we want to dive into how the actual infinite banking works. And when you think about infinite banking, truly what it is in the structure, you as the policyholder are going to put your premiums inside of an insurance policy, a participating whole life policy. Once again, participating means you participate in receiving dividends back. And then that money gets split up between insurance coverage and cash accumulation. And typically, when the whole idea comes around for the infinite banking, what it is that the policyholder wants to take out loans. And when they take out loans, this is where it gets a little interesting. So the whole life carriers have a fixed loan rate. It's usually either anywhere from 5 to 8%, depending on the carrier. I believe Northwestern, at the time of me saying this, is about 8%. New York Life is around 5. That is a fixed static number, and it's not going to change. And so the whole idea is that if you have to borrow money, and then you go, say, utilize that money towards an investment property. Good example, Walt Disney used cash value life insurance to help start the most magical place in the world. So you can use the accumulation as a source to fund other projects. And in that scenario, you are using your own money. So you're technically being your own bank, if you will. And then when you take that loan and you pay it back, you actually get the interest back with that. So the whole idea is that you are actually paying yourself back the interest versus actually paying it out to a bank. That's why they call it infinite banking. It's also called bank on yourself, infinity banking, however you want to say it. The whole idea comes from the fact that you can borrow money from your insurance policy. There is going to be interest that accumulates, but that interest, once you pay the loan back, will be part of your cash value. There are still dividends that come into the policy that add on to that benefit. And ultimately, there's still a life insurance piece attached to it. So at time of death, it will pay out to your beneficiaries. So that's infinite banking in a nutshell. The big piece about it, the big sizzle to the steak, is the loan piece that you get that interest tacked back on when you pay the money back. So that's the big important part, when you pay the money back. Now, on the flip side, we have tax-free retirement. So people who typically sell more IUL type of sales will start talking about these. It's also heard LIRP, Life Insurance Retirement Plan, SERP, Supplemental Executive Retirement Plan. So there's different ways that people talk about tax-free retirement versus infinite banking. So if we look at the fundamental piece of the tax-free retirement plan, it is the IUL. So when you think about the IUL, or you think about the typical client who wants an IUL, it's the people who want that type of coverage that's a little bit more cost-efficient premiums. So when you think about it, the premiums, as I mentioned, whole life gives you a partial refund of your own money back for dividends. That means you're overpaying on your insurance. Here, you have more cost-efficient premiums. If you run the numbers like a death benefit sale, usually the same face amount for an IUL compared to a whole life is about half the premium. And it's not that it's a bad thing. There's differences, and we'll explain pros and cons here at the end. But that's why we say a more cost-efficient premium, the IUL can make more sense. You also have the ability to have flexible premiums. And that's interesting too, because in the whole life example I showed you, 35-year-old preferred plus non-tobacco, the premium was $65.25 a year. That's what he had to pay for his whole life. In this example, if the cash accumulation is technically doing better, you can pay less. Or if you want to skip a year, you can double up the next year. you have some flexibility with IULs that you don't have with whole life. If there were no dividends, we're taking that extra piece out of the equation, and you skipped a premium payment, then a loan would automatically be charged to your policy, or it could go into a non-forfeiture option, which could be an extended term, or lapsing the contract. So there is more flexibility with the premium design inside an IUL versus a whole life. Now, if you're someone who doesn't mind a little bit more risk for reward, the IUL can make more sense too, because it has the opportunity, and I underscore the word opportunity here, opportunity to accumulate more cash value because you're actually investing inside market type returns. So the other thing too, when you talk about how those funding options work, most carriers have at least one, like the S&P, which is a normal, a staple IUL index. Some carriers will have proprietary indices. My prior company had about 4 total, including the S&P. And so the opportunity there to have some variation or segmentation with that downside protection of 0 gives your client, once again, an opportunity to have a higher ceiling versus a whole life carrier, because the dividend you get back is dictated by the carrier. In this scenario, you have market performance dictated by how the S&P does. So 500 of the top companies in the United States. And so how this works, understanding how the IUL policy cash accumulation works, the surplus of cash after fees. So once again, just like the whole life policy, you deposit a premium, the charges come out first, and then that residual remainder then goes into your cash account and is applied to an index strategy. Once again, you're not putting your client or your money into the actual market. You're applying that extra surplus of cash into an index strategy that will mirror the market. For example, sake, the S&P 500. Now, you do have different index options. There's different ways that it can be done. There's either PARS, participation, or caps. So caps, very easy explanation. We don't care about the middle. We only care about the first point, like today and a year from today. So if the S&P starts at 1,000 points and rises to 1,200, that's a 20% growth. Now, in that scenario, you may have a cap of 10% on the index strategy or the S&P 500, so you would be credited 10% to your account. Now, if it went the other way, 1,000, and after that year is over, it dropped to 800 points, and you have a loss, you'll be credited 0%, no market loss. So you participate in the upside, but you have none of the downside risk. Now, if you talk about participation, so when I talked about that strategy where it was a 10% cap, say I had a 90% participation on the S&P 500, and in that same scenario we talked about a 20% gain, then I would actually get 80% or 18% credited to my account because I had participation. It works differently, so talk to your financial professional about which one works better for you if you're doing an indexing strategy. PARS, caps, or a combination of both. But at the end, you get credited once that bucket matures, which is usually a 1-year point to point. And then a new point starts with the additional premium put in the next year, as well as the crediting of what you already had, and it starts to compound and grow. And so when you think about how the IUL structure works, when you're talking about a tax-free retirement strategy, very similar to the whole life. You pay the premium, moves the fees, cash value growth. Now you can pull out money through loans as well. However, the whole life carriers have that 5 to 8% fixed loan. The IUL type carriers have a different type of strategy. You have the choice of a standard loan, which is usually after 10 years a net zero cost. They usually charge 3%, credit 3%, so it's net zero cost. In the first 10 years or so, with most carriers, it's about 1% net total cost. But then if you talk about the participating loans, that means you're keeping your money in the index strategy. It'll be charged anywhere from 4 to 5%, can go up or down depending on carrier. But it keeps your money active in the market so you can participate in any of those market gains. So if you had a 10% return, like we talked on the last slide about, and you had a 5% loan charge, well, you would get 5% credit on that borrowed money. What they don't tell you with whole life too is when you borrow money, that borrowed money goes on a reduced dividend scale, usually about 50%. Oftentimes, when we talk about positioning for tax-free retirement, we in the industry love talking about it in buckets. So there's usually three buckets: a tax now bucket. When you think about CDs, money markets, mutual funds. So anyone who listens to Dave Ramsey or Susie Orman always hear about putting your money in mutual funds, but they never tell you which ones to put them into. And then if you want to find someone to tell you to do it, they usually charge you a fee every year, 1.25% that continues. So there's no free lunch, right? Tax later is where most people put their money. About 95% of retirees have put most of their money into the 401k bucket because they want to do the tax deferred contributions and get the tax deductible piece to it as well. Now, we in the industry know that taxes are more than likely going to go up as you talk about debt ceilings rising. You had COVID relief, you have, trillions of dollars in debt. So at some point, we're going to have to pay the piper. And our marginal tax brackets today are at an all-time low. Even the top marginal tax bracket, 37, 39%, somewhere around there, is one of the lowest it's ever been. If you look towards about the Great Depression time, the top marginal tax bracket was about 90%. That's when stuff like the 401k made sense. So if you think about a tax never vehicle, reposition some assets, not all, because there's still a benefit to 401ks, but some assets to a cash value life insurance policy. It's like a Roth on steroids. You can do more than 6,500 per year inside of a life insurance policy. If I pass away tomorrow and I made a payment today on my policy, my wife now gets a retirement plan because it's tax-free death benefit that she wouldn't get if I invested in a Roth. And you have that downside protection, no upside opportunity, and you can take the money out before 59 and a half. So you have some extremely beneficial pieces to the cash value life insurance versus even a Roth. And I use an example here where we had, being a Ravens fan, put up Ray Lewis, but, you can use whoever you want. In this scenario, we funded $20,000 as a contribution for 25 years. So a total of $500,000. It grew to about 1.3 million over time. And then we took out distributions of about $3.6 million over a 25-year period. So when you think about tax-free accumulation opportunities, this is where you can get an extremely high growth opportunity. And so that's your tax-free retirement strategy, how you can position that. So we're not really focusing too much on the give you your money back with interest. It's more or less you have the opportunities when you take loans to not pay them back. And if you want to continue to participate in the market, you can get higher returns. That's your positive cash arbitrage. So when we look at the differences between the two, the IUL has typically lower premiums per same face amount if you're just talking a raw policy, and they're flexible. The whole life is a bit more rigid, so you regimented with your policy, you keep paying the premiums. The IUL pricing could increase with poor performance. So when you partner with me, what I typically talk about is the situation where we want to underpromise and over-deliver when we talk about IULs. Showing illustrations around 7%, it should not be what we should be illustrating at. I would say 5 to 6% is a good marker, maybe even 6.5%. But when you get higher than that, the likelihood of probability starts to shrink. That's why they created rules in play over the last few years to help mitigate that type of illustration design and make it more realistic. So you could have an increase of poor performance, and on the flip side, you could have a decrease in premium with higher performance. With whole life, potentially with dividends, you could either lower your premium or get rid of it completely. Once the dividend reaches the premium amount, then you can typically stop paying on a whole life policy. Death benefit, there is flexibility to adjust IULs. You can reduce the face amount after a specified period of time. On the whole life side, it's really more about the lifetime guarantees, so the focus is different. But you can get an increase with dividends. The IULs, you can guarantee them depending on which ones you pick, and you could do a level or an increasing option with them too. But when you talk cash value, you can't really see the arrows that well, but I just highlighted a couple carriers. This is a 10-pay product with a whole life carrier. So you are stuffing more money into the policy. In this example, 20,000 and you get 10,000 right off the bat. With this carrier, you got 20,000 and you got 7,000 right off the bat. But if you span it out over time and you think about the idea of an investment strategy, most of the time, the longer you invest, the better likelihood you have of success versus people who get afraid of pulling their money out at the wrong times. And in this scenario, after 10 years, including dividends, the whole life policy is at about 212,000 and the IUL is at about 222,000. This is on a 40-year-old male. And if you can think about that, the trajectory will continue to show a higher number for the IULs. IULs usually show really, really well around 15, 20 to 30 years out. And so when we think about that, even just kind of comparing it, we look at New York Life, 466,702 at 65. AIG at a 6% rate of return is 593,000. So you have over $100,000 more in accumulation by using the same premium and the same concept. You also have a higher death benefit. Now, if you really want to stress test the product and do a 5%, you still have higher accumulation in cash value, but you do have a lower death benefit. So in this design, it was minimum face, maximum accumulation. So it's a different angle versus, for example's sake, looking for a higher death benefit. So it just depends on what the client wants. And there's always risk for both companies or both types of products. I'm not here to tell you that one is better than the other. I'm just here to give you differences and let you make your own educated decisions. IULs, they could have too many zeros in their years of returns. Here in 2023, we're witnessing, more down years. Does that mean it's a bad time to invest? No, it just means now's a better time because you're getting it at lower data points. And so, but once again, that's usually the phraseology you'll hear from whole life side is there's too many zeros, it could lapse, this and that. But if you have the right professional showing the right illustration, you shouldn't have that concern. Cost of insurance can increase, absolutely. They can increase based on market performance, how much you're investing in the contract. So yes, pars and caps can reduce too. Right now, the pars and caps have risen because the interest rates have risen. And so you're seeing a better opportunity on pars and caps. But as interest rates will drop, so can the pars and caps as well. So just kind of be aware that there is fluctuation with that too. Once again, mitigating your illustration rate will help you from curbing that overpromise and underdeliver. And yes, it does have the potential to lapse. You are paying less premium than a whole life policy, so there is a little risk with that. On the flip side, when you talk about the whole life, the costs are higher. You could ask any whole life carrier to show you the policy costs, and they won't because they can't. Like I said, I've got the carriers. I can't even show the expense charges. Cash value doesn't grow as well as an IUL. It is the turtle versus the hare in this scenario. And you're really relying on the dividend being paid out by the insurance company. Let's be honest, in this industry, no one has ever missed a dividend. but it's still a non-guaranteed piece to the equation. Speaking of dividends, just one thing that we should understand is that they have been on a skid for the last 20 years. And so I remember selling whole life at MetLife around 2010-ish time frame. And at that time, we were at an all-time low for the dividend. And then the next year, it got worse. And I was telling the financial advisors I work with, I was like, oh, don't worry, it'll be better next year. And it got worse again. So I learned to be quiet after the third year. So what you see is that the dividends have been on a decrease. They may have increased recently because of the giant, bull market that we've had. But for the most part, those illustrations that have been done in the early 2000s are not accurate to what you're seeing today because of the reduction in the dividend. But once again, when you think about it, in conclusion, really, there is no right or wrong in this. I wanted to just kind of uncover the fact that some people will position things differently because that's the only thing they know how to sell. But the beauty of this model, the beauty of what you have here with me today, is you have both products. You can explain the pros and cons. It's all about objectivity, what's right for your client, and ultimately what's beneficial in the long run. If you think about certain clients, they want that top shelf policy where they know they pay a premium, they know they're getting guarantees, and they want to put it away and not think about it. We have other clients who are a little bit more geared towards a higher investment or higher opportunity. And for them, the IULs make more sense. So you have your different clientele. It's all about asking the right questions to find the right answer. And so, truly, again, when we talk about what we're talking about today, just to recap, infinite banking, the good story with that is that it has the whole life component to it. You got dividends, you get cash back when you pay the loan back that you basically borrowed against, so you are your own bank. On the flip side, you have tax-free retirement, you have lower loan costs, lower charges, and so if you don't want to pay the money back, the IUL can seem to make more sense. Forgot to mention it inside the screen or inside the presentation, but the other thing to observe, typically with the whole life policies in the first few years, if you're truly overfunding it, I mean, literally the first few years, they're going to have better cash performance. But long term, you'll see the better opportunity with the IULs. So with that, I just want to say thank you for joining today. And what you'll find is I'll upload this to the YouTube channel where there's additional presentations and opportunities to learn and grow. If you'd like to learn more or want to get on the weekly trainings that we do, please feel free to email me or give me a call. And I will end the recording and open it up for questions. So